Good morning, everyone, and welcome to Julius Baer's Moving Markets podcast. It's Friday, the 24th of April, and my name is Helen. My first guest this morning will be Lucija Caculovic, and she'll be giving us a roundup of the latest news in financial markets. And Tim Gagie is back, so he will be my second guest this morning, and he'll be filling us in on the latest moves in FX and metals markets. But first up with the market news, it is Lucija. Good morning, Lucija. Thank you for joining me.
Good morning, Helen.
Global signals yesterday were sort of mixed. Looking at the macro picture, we saw a clear divergence between the US and the eurozone in the latest PMI data. Can you talk us through that first, please, Lucija?
Yeah, so starting with the US, the data points to surprising resilience. Flash PMIs rose to a 3-month high in April, signaling expansion. Manufacturing stood out, posting its strongest growth in almost 4 years. Companies appear to be preparing for potential disruptions linked to the situation in Iran by building inventories. That precautionary stockpiling is boosting demand, but it is also pushing prices higher, with inflation pressures back at levels last seen in mid-2022. Now, despite that strength, business confidence remains subdued, with expectations still historically low.
So it's a somewhat paradoxical picture in the US, with strength at the moment, but tempered optimism. How does that compare with Europe?
So the contrast is stark, Helen. The eurozone slipped into contraction in April for the first time since late 2024. The main drag came from services, which slowed sharply as consumer confidence weakened amid the war in Iran. While German manufacturing held up reasonably well, services weakened considerably. Similar to the US, price pressures are mounting across the board. Higher energy prices and rising commodity costs are pushing input costs to their highest level since 2000, excluding the pandemic period.
Moving on to the US labour market, we got jobless claims numbers yesterday. Any noteworthy trends there?
So initial jobless claims ticked up slightly, exceeding expectations, but remain at subdued levels. Continuing claims also edged up marginally. So overall, the labor market appears to be stable, slightly cooling and showing no cracks. Some think that the absence of widespread layoffs supports the expectation that the US Fed will not change rates this year.
And the Swiss National Bank seems to be taking steps to manage the franc's strength. What's happening there?
Yeah, Helen, so the recent balance sheet data suggests the S&B intervened in the FX market in March, though on a smaller scale than during last year's tariff-related turmoil. The aim is clearly to limit safe haven inflows into the franc. Our economists expect the S&B to step in again if needed, while keeping the policy rate at 0% through 2026 and 2027. Staying with the S&B, Chairman Schlegel also warned in an interview today that Switzerland's economic outlook depends heavily on how long conflict-driven energy price pressures last. Prolonged high energy prices, he said, could stoke inflation and weigh on growth.
All right, and turning to equity markets, how did things play out yesterday?
European stocks ticked slightly higher, but sentiment remained cautious. France and Italy outperformed, while the UK, Germany and Spain saw losses. In the US, stocks pulled back. The S&P 500 slipped after briefly touching a new intraday high, while the Nasdaq underperformed. Software stocks were hit particularly hard. IBM and ServiceNow fell sharply after earnings, dragging peers like Microsoft, Oracle and Palantir lower.
And speaking of specific companies, L'Oreal and Nokia stood out as strong performers yesterday. What drove gains for these stocks?
So L'Oreal delivered its fastest quarterly growth in 2 years, sending shares soaring. Nokia, meanwhile, benefited from robust first quarter earnings, fueled by a 4% year-on-year increase in net sales and a substantial jump in operating profits. Their CEO highlighted opportunities in AI, particularly within optical networks. Interestingly, even defense giant Saab saw its shares rise despite a dip in order bookings, and that's attributed to a shift towards more medium-sized contracts.
And then on the flip side, we also saw some negative headlines with Meta cutting jobs and American Airlines lowering its guidance.
That's right. Meta is trimming about 10% of its workforce as it streamlines operations and reallocates spending towards AI. Meanwhile, American Airlines cut its full-year earnings outlook after fuel costs jumped by around $4 billion.
Let's talk about commodities quickly, Lucija. Oil prices continue to climb.
Yes, they do. So Brent crude topped $104 per barrel yesterday and is even higher this morning. The IEA is warning of the biggest energy security threat in history, highlighting potential disruptions to jet fuel supplies in Europe and the need to reassess trade routes. The gold price dipped slightly yesterday and is again lower this morning. It is pressured by a strengthening dollar and those elevated oil prices.
And in today's Asia Pacific trading session, most markets are in the red, with Japan being the notable exception. What's driving that?
Yeah, Japan's Nikkei and Topix both moved higher after core inflation accelerated for the first time in 5 months in March, rising to 1.8%. Higher energy prices are a key factor. This inflation data will be closely watched by the Bank of Japan at next week's policy meeting, where policymakers are still widely expected to refrain from raising interest rates.
All right, let's look ahead then. What key data releases should investors be paying attention to today?
So we've just got UK retail sales for March, which came in much better than expected. Later today, attention turns to Germany's IFO Business Climate Survey, as well as the final reading of the University of Michigan Consumer Sentiment for April. As for US stock futures, they were trading mixed when I last checked, so let's see what the day has in store for us.
Wonderful. Thanks a lot, Lucija, for the great roundup this morning.
Thanks for having me, Helen.
And now over to you, Tim. Good morning, firstly.
Good morning, Helen.
So great to have you back on the show, Tim, after your break. What has struck you most, would you say, about how the markets have evolved over the last 6 weeks?
Thanks, Helen. It's nice to be back. Well, the main thing that I would see is how little has changed, really, especially taking a look at FX. Once again, currencies seem to revert to their previous levels, even as equity markets go from pain and panic to all-time highs. Eurodollar was 116 when I left, and it's not really up much above 116 now. So even if we did see 114 and 118 in the meantime, nothing really happened there. Same story in cable, same story in dollar Swiss. There's a few outperformers, Norwegian kroner, for example, which makes sense given the continued pressure on oil prices. But apart from that, it's just directionless. And I think it still reflects the same theme and the same problem that we've been wrestling with for quite some time, which is when fundamentals continue to collide with yields. Everyone still wants to short the dollar, and the reasons why have not changed. But the trouble is, especially against the euro and the Swiss franc, it's very expensive to sell dollars. Same story for the yen, naturally. So it's not for nothing that the currencies that are holding up better, such as the Aussie dollar, the Norwegian kroner, and some emerging markets, are those currencies where yield is at worst equal to, and in some cases better than, that of the US dollar. So for that reason, I would continue to favour these currencies, and I think this is a story that's just going to continue to be the case.
Metals have come under pressure again. Do you think this presents any opportunities?
Yeah, I do. We still have a positive longer-term outlook on gold. Volatility is held up reasonably well. So you can still pick up a decent coupon in a reverse convertible, for example, with a strike that's quite conservative. And I think I'd prefer not to buy gold directly. The resumption of the uptrend is not clear yet, and already we're down about $150 odd from middle of the week. So it's not quite clear yet that right here's the perfect entry point. But I would stay long, and I think there's a bit of an opportunity. I think the other metals, though, it's all a bit tactical. Silver's intraday swings are not as wild as they were earlier in the year, but $4 on the day yesterday is not bad and could be painful if you get it wrong. So I would really keep any trading in silver quite light in size. Platinum got a bit sticky around 2000, and there I think I'd probably rather wait, and palladium has just been completely forgotten. So I think I would really just focus on looking for opportunities in gold where the fundamental picture is the clearest.
And next week, there's the main central banks meeting. Do you foresee any surprises there?
This is hard to say. I mean, it'll be very interesting to hear from the Fed, the Bank of England, and the ECB for the first time proper since the war began. I mean, we did have meeting shortly after the first attacks, but last time they didn't really have any time or information, and this time round, even if they don't have maybe much more clarity, we have had time to see impacts on energy prices and to see that the flow of goods in the Strait of Hormuz is going to be greatly reduced for some time. It's still early to know the real effects on inflation, but with oil prices already higher, the outlook is different. And while I don't really expect any action from any of the three central banks, I do think they will have to adjust what they say and will have to try and give some direction to the market about what they expect to happen and what they might need to do. So far, the market's not really pricing in anything in particular, but the rate cuts that were priced in for the Fed are long gone, naturally, which means that any potential hikes from the ECB in particular are going to be much less impactful for those currencies against the dollar, and be another reason why I think it's going to be difficult to really see a much weaker dollar. But we're going to need to listen very carefully to Powell, Bailey, and Lagarde next week. Finally, Helen, my friend went to the doctor last week, and the doctor said, "I'm afraid the outlook is not good. It's really very bad." My friend said, "Oh gosh, doctor, but I mean, how much time do I have left?" And the doctor said, 5. My friend said, "But 5 what? 5 years? 5 months?" The doctor said, 4.
Very good. Thank you, Tim. Great to have you back on the podcast this week. So that is all for today. Thank you again to my guest this morning, and thank you all for tuning in. Please subscribe to our show if you enjoy it, and you can, of course, also leave us a review on whichever platform you like to listen on. So we'll be back again on Monday morning. Do join us then when Jan Bopp will be your host, joined as always by more of our colleagues to talk about what is moving markets. But until then, I wish you all a great day and then a great weekend. Bye for now.
The information and opinions expressed in this podcast constitute marketing material and are not the result of independent financial or investment research. Please refer to www.juliusbaer.com/legal/podcasts for further other important legal information.